Hey everyone, and welcome to The Explainer. Today we're going to break down those three letters you see pretty much everywhere, on your coffee bill, your online shopping cart, you name it, GST. So what is it really, why do we even have it, and how on earth does it work? Well, let's dive in.
I mean, we've all been there, right? You get a bill, you look at the total, and then you see it, broken out into CGST and SGST. It's part of our daily lives, but let's be honest, it can feel like a total black box. So to really get what's going on, we first have to understand where GST even fits in the grand scheme of taxes.
In India, you can basically think of taxes in two big buckets. First up, you've got direct taxes. Think of your income tax. As you can see here, that money goes straight from you to the government. You can't pass that burden on to someone else. But then there's the other bucket, indirect taxes. And that's where GST lives. Here, the burden can be shifted. The person paying the tax to the government isn't always the one who's actually footing the bill.
Let's make this super simple. Imagine you're at the supermarket. You buy your groceries, and the supermarket tacks on GST to your bill. They collect that tax money from you, and then they turn around and pay it to the government. So in the government's eyes, who's the taxpayer? The supermarket. But where did that money really come from? Yep, your wallet. The business is basically acting as a tax collector for the government. That's the whole idea behind an indirect tax.
All right, so here's our game plan for this explainer. We're going to start with what GST actually is. Then we'll take a look back at the complicated maze it replaced. We'll walk through exactly how it works with a really clear example, figure out India's unique dual tax setup, and finally, we'll cover the few things that are still not part of the GST club.
So let's get official. GST stands for Goods and Services Tax. It's a comprehensive tax that's put on the supply of pretty much any good or service. It was rolled out on July 1st, 2017, and it was a massive, massive reform meant to replace a whole jungle of other taxes and hopefully create one unified market across India.
So you have to ask, why go through all that trouble? What was so bad about the old way of doing things? Well, to put it mildly, before 2017, India's tax system wasn't so much a system as it was a tangled mess. Every state had its own rules, and businesses were stuck trying to figure it all out.
Yeah, the old system was just riddled with problems. Just look at this list. Businesses were drowning in paperwork trying to deal with central excise, state VAT, service tax, you name it. It was incredibly complex. But the biggest problem, the real villain of the story, was something called the cascading effect. Now this is where it gets wild. Let's see how this cascading effect actually played out. So a manufacturer makes something for 1,000 rupees. The central government slaps on an excise duty, let's say 100 rupees. Now the cost is 1,100 rupees. The manufacturer adds their profit, so the price is now 1,500. But wait, we're not done. When it's sold, the state government would come in and add another tax, called VAT, on the entire 1,500 rupees. And there it is. Did you see what happened? That VAT wasn't just on the product's cost and the profit. It was also charged on the excise duty that had already been paid. You were literally paying a tax on a tax. This just bloated the final price for everyone, and it was the single biggest problem that GST was created to fix.
Okay, so how does GST fix this? Well, it gets rid of that whole tax-on-tax mess because it's a value-added tax. In simple terms, tax is only charged on the value that's added at each step of the journey. And the secret sauce that makes this all work is something called the input tax credit, or ITC.
To really see this in action, let's follow a product on its journey. It starts with the manufacturer, gets passed to a wholesaler, then a retailer, and finally it lands in your hands, the consumer. At every single step, value is added, and that's where GST comes into play.
All right, stage one. The manufacturer sells their product to a wholesaler for 10,000 rupees. They collect a 10% GST, so that's 1,000 rupees. Now, since they're the first person in the chain, they've created all the value so far, so they pay that full 1,000 rupee tax to the government. Pretty straightforward.
Now this is where the magic of input tax credit happens. The wholesaler buys the product for 10,000 and sells it to a retailer for 12,000. So they've added 2,000 rupees of value. They collect 1,200 in GST from the retailer. But, and this is the brilliant part, they don't pay that whole amount to the government. Nope. They get a credit, that's the ITC, for the 1,000 rupees in tax that the manufacturer already paid. So they only have to pay tax on their value add, which is just 200 rupees.
And it's the exact same logic for the retailer. They buy for 12,000
and sell it to you for $14,400. They collect $1,440 in GST, but they get to claim the $1,200 in tax paid by the wholesaler as their ITC. So what's their net tax bill? Just 240 rupees, which is exactly 10% of the value they added. See the pattern?
So here's the crucial takeaway. You, the final consumer, pay a total of 1,440 rupees in GST. Now, let's add up what each business paid the government. 1,000 from the manufacturer, 200 from the wholesaler, and 240 from the retailer. What does that equal? Exactly 1,440. The entire tax burden is passed seamlessly to the end consumer, and the government gets its money without any of that messy tax-on-tax stuff.
Now here's something that makes India's GST pretty unique. A lot of countries just have one single national tax, but we have what's called a dual model. This just means both the central government and the state governments get to charge and collect the tax at the same time. This was a really key part of the deal to get all the states to agree to this new system.
So, how does that work in real life? Well, if a sale happens within the same state, say Mumbai to Pune, the total GST gets split right down the middle, 50-50. Half goes to the central government as CGST, and the other half goes to the Maharashtra government as SGST. But what if the sale is between states, like from Tamil Nadu to Andhra Pradesh? Then a single tax called IGST, or Integrated GST, is charged. The central government collects it all and then makes sure the state's share gets to the destination state, in this case, Andhra Pradesh.
And this brings us to another really fundamental change. GST is a destination-based tax. This was a huge shift. It means the tax money goes to the state where the stuff is actually consumed, not where it was made. This helps spread the tax revenue more fairly across the country, especially benefiting states that buy more than they produce.
Now, while the big idea was one nation, one tax, it wasn't quite that simple. GST did replace a ton of old taxes, but a few key items were kept out of the new system, usually for some pretty big economic and political reasons. But first, let's just take a moment to appreciate the cleanup GST did. All those major taxes like central excise and service tax, gone. And on the state side, things like VAT, sales tax, even entertainment tax, all of it got rolled into this one single tax. It was a huge simplification.
But here are the big exceptions. First, alcoholic liquor for human consumption is completely outside of GST. This is a huge moneymaker for states, and they weren't ready to give it up, so it's still taxed under the old system. Petroleum products like petrol and diesel are also outside for now, but the door is open to bring them in later. And finally, you have tobacco. It's a bit of a special case. It is inside GST, but the central government can also add an extra central excise tax on top, basically to make it more expensive and discourage people from using it.
And all of this was done with one big idea in mind: one nation, one tax, one market. The whole ambition was to turn India into a single, seamless economic area, knocking down the tax walls between states and just making it easier to do business anywhere in the country.
It was, without a doubt, one of the biggest economic reforms in India's history. But the big question still hangs in the air. Has it really achieved everything it set out to do? Has it truly simplified things and fired up the economy? Or is this massive journey of transformation actually just beginning? Well, that's a debate that's still going on today. Thanks so much for watching.